In a surprising turn of events, a joint currency intervention by Japanese and US authorities has nudged the dollar-yen exchange rate close to 157. But don't be fooled, analysts caution that this move only buys us a little breathing room. Stick around, and by the end of this video, you'll grasp the core policy gaps fueling the ongoing weakness of the yen, as well as what a 30-year high in Japanese short-term bond yields could mean for global markets. Tokyo faces a significant challenge, a deep-seated disconnect between currency intervention efforts and monetary policy. While the Ministry of Finance and U.S. officials are stepping in to support the yen, the Bank of Japan continues to take a relaxed approach. Without a clear shift toward higher domestic rates, market players see these official dollar sales as merely a temporary stopgap against the powerful forces pushing the yen downward. In concrete terms, the US dollar to Japanese yen is hovering around 157 during Asian trading hours, as the effects of last week's intervention still linger. Notably, Japan's two-year bond yield has surged above 1.57%, marking its highest point in over 3 decades, despite government efforts to stabilize the currency. Meanwhile, New York Fed President Williams has indicated that while US inflation may ease, further rate hikes are still on the table. In a related note, South Korea's CPI fell by 0.2% month-over-month, underperforming expectations of a 0.1% decline. On social media platform X, real-time commentary reveals a wave of skepticism among traders. They underscore the reality that mere market interventions cannot bridge the substantial interest rate gaps. Observers point out that maintaining US dollar to Japanese yen near 157 illustrates the limitations of official actions, especially when the underlying BOJ policy remains lenient. There's also a significant focus on the historic rise of two-year JGB yields, with investors viewing this as an indication that bond markets are preparing for necessary rate adjustments. Professional analysts and institutional reports convey a stark message: the joint US-Japan intervention merely buys time for policymakers. Top market analysts warn that without genuine monetary tightening from the Bank of Japan or macroeconomic alignment, physical intervention will only provide temporary relief. Financial institutions are keenly aware that hawkish comments from Federal Reserve officials about potential future rate hikes continue to strengthen the US dollar against other currencies. The rise in short-term Japanese yields past 1.57% introduces a complex scenario for Japanese equities. Banking and financial sector stocks are facing immediate repricing as these yields reach multi-decade highs, which may improve net interest margins. However, other domestic sectors are grappling with tighter monetary conditions, while export-oriented companies remain vulnerable to sharp currency swings around the 157 mark, especially when intervention rumors circulate. The ripple effects of Japanese bond yield volatility are being felt across global asset classes. Rising domestic yields in Japan could draw foreign capital back, which would influence international fixed income markets, including US Treasuries. At the same time, foreign exchange markets are on high alert as gold prices remain steady near 40.50, amidst widespread FX uncertainty and the persistent strength of US interest rates. For retail investors, navigating the current market landscape calls for strict risk management. First, keep a close eye on short-term JGB yields along with communications from the BOJ, as pressure in the bond market often prompts policy shifts. Second, steer clear of unhedged, one-sided FX positions while intervention warnings are active near 157. Lastly, track US inflation data and Fed policy signals closely, as the strength of the dollar remains a major market driver. Looking ahead, 3 primary scenarios emerge based on macroeconomic modeling. In the base case, intervention stabilizes US dollar to Japanese yen around 155 to 158, while the rising 2-year yields gradually push the BOJ toward policy normalization. In the bearish scenario, if the Fed resumes rate hikes and the BOJ hesitates to tighten, we could see US dollar to Japanese yen breaking intervention defenses and heading toward 162. Conversely, in the bullish scenario, Aggressive BOJ rate hikes in tandem with coordinated G7 action could stabilize the yen below 150. To wrap it all up, the joint currency intervention buys some time, yet the loose stance of the BOJ continues to exert pressure on the yen, hovering near 157, as 2-year JGB yields reach 30-year highs above 1.57%. We'd love to hear your thoughts. Drop a comment below, hit that like button, and subscribe for more in-depth insights into the Japanese market.